Have you ever looked at one of those huge global companies and just wondered, how does it all work? With all their different brands and divisions, how do they actually make money? Well, today we're going to peek inside that corporate black box. Let's get into it. Right? It's the big question. You see a headline saying some mega corporation made billions in profit, but that one giant number, it hides the real story. It's kind of like looking at a mountain from super far away. You see the shape, but you have no clue which parts are soaring high and which are struggling down in the valleys. So let's imagine a company, we'll call it Global Corp. They announced this incredible $50 billion profit. Amazing! But what does that actually tell us? Is their flashy new tech division the reason, or is their old reliable manufacturing arm secretly losing money? We're completely in the dark with just this one number. Well, luckily, there's a rule for that. It's called IFRS 8, and this right here is its core mission statement. It's a global accounting standard, but don't let that fool you. Its whole purpose is to force companies to open up and show us the moving parts, so that investors, employees, so that you can see what's really driving the business. Okay, so how does IFRS 8 actually pull this off? It all starts by making companies break themselves down into what are called operating segments. Just think of them as the main puzzle pieces of the business seen through the eyes of the people who are actually running the show. Now, here's the official technical definition. I know, it looks a little dense, but it's actually really logical when you break it down. It's just a part of the company that's an active business, that the bosses are keeping a close eye on, and that has its own separate financial numbers. Let's make that even simpler, though. You can really just boil it down to these three simple questions. 1, is it a real business that makes money and spends money? 2, do the people in charge review its performance? And 3, does it have its own set of books? If you can say yes to all three, boom, you've got an operating segment. The key here is that this is based on how the company is actually managed on the inside, not on some slick marketing brochure. And a quick but really important point about the boss. The official term is the Chief Operating Decision Maker, or CODM. But what's cool is that this isn't always the CEO. It's a function, not a title. It could be a committee, the COO, or whoever's actually in charge of deciding where to put the money and checking on how these different parts of the business are doing. It's simply whoever calls the shots. All right, so the company has figured out all its different operating segments, but that doesn't mean you're going to see a detailed report on every single one. I mean, can you imagine a report with 50 different sections? It would be a nightmare to read. So IFRS 8 has this filtering system to decide which segments are important enough to actually get their own spotlight in the financial statements. And the very first filter, the big one, is what we can basically call the 10% rule. It's a really straightforward way to measure if a segment is big enough to matter to someone on the outside looking in. So for a segment to get that spotlight, it only has to meet one of these three tests. Is its revenue more than 10% of the company's total? Is its profit or even its loss a big deal, more than 10% of the total profits or losses? Or does it hold more than 10% of the company's assets? Let's look at how this works in practice. Okay, back to Global Corp. This table shows the rule perfectly. You can see right away the electronics, software, and cloud services divisions are massive. They blow past the 10% test on every single metric. But now look at R&D and the corporate overhead. They're just too small. They don't hit that 10% mark on anything, so they won't get their own separate report. So we've used the 10% rule to find the big important segments. But hang on, there's one last check to make sure the company is really being transparent enough. It's called the 75% test. Basically, IFRS 8 says that the total revenue from all those reportable segments, the ones that pass the 10% rule, has to add up to at least 75% of the company's total sales to the outside world. If it doesn't, the company has to start adding its next biggest segments to the report, even if they're small, until they cross that 75% line. It's a great safety net that stops companies from hiding too much of their business in a vague other stuff category. So we've figured out which segments make the cut. Now we get to the really good part. What information does the company actually have to share for each one? This is where that black box really starts to open up. For every single reportable segment, a company has to tell you some crucial details, things like how much revenue it gets from external customers, but also how much it makes from selling things internally to other parts of the same company. And most importantly, they have to report a measure of profit or loss, and usually their total assets. They also have to give you a basic description of what that part of the business actually does. Now you might be thinking, Okay, if they give us all these separate profit numbers, how do we know it all adds up to that big company-wide number from the beginning? Great question. The answer is a critical step called reconciliation. They literally have to show their math. And a reconciliation looks something like this table. You see, it starts with the combined profit from all the big reportable segments. In our example, that's $65 billion. Then it subtracts stuff that doesn't belong to any one segment, like the cost of running the corporate headquarters, makes a few other adjustments, and there it is. It ties out perfectly to that $50 billion total company profit we started with. Nothing can be hidden. So after all those rules and tables and numbers, let's bring it back home. Why does any of this really matter? Well, it's all about changing how we see a company, going from one blurry, out-of-focus dot to a super sharp, high-definition picture. Honestly, the difference is just night and day. Before, all you had was this one mysterious profit number. But after, you can see exactly which parts of the business are the true profit engines. You can spot a struggling division that might be a hidden risk, and you get real data-driven clues about where the company's future growth is actually going to come from. And this isn't just for financial analysts on Wall Street. This information gives you power. If you're thinking of investing, you can make way smarter decisions. If you work there, you can really understand the health and the strategy of your own employer. You can size up a competitor, and you can finally see past all the marketing hype to what's really going on under the hood. So the next time you look at a company's annual report, don't just stop at that big headline number. Go find the segment information. Now you know how to peek inside that black box. Which leaves just one question. What's hiding in plain sight in the companies that you care about?